Imagine opening your investment app and seeing 1 month's salary disappear in a single day. Not because you spent it, not because someone stole it, but because the market turned red. Now imagine that happening again tomorrow. And the day after that. That is when most people stop acting like investors and start acting like survivors. But here is the real question. Why do most people panic during market crashes, even when they already know crashes are a normal part of investing? The answer is simple. People do not invest with money alone. They invest with emotions, dreams, fear, ego, pressure, and sometimes their entire identity. When the market is rising, everyone feels smart. A person buys a stock, it goes up, and suddenly they feel like a financial genius. They start believing they have a special talent. They watch videos, read posts, follow experts, and feel like they finally understand the game. But when the market turns, that confidence can disappear very quickly. A crash does not only reduce account balances, it attacks people's belief in themselves. Suddenly, the same person who was proudly saying, "I'm investing for the long term," starts asking, "Should I sell everything?" One bad day creates worry. One bad week creates fear. A full market crash creates panic. And the strange thing is, this has happened many times before. During the 2008 financial crisis, the S&P 500 fell around 57% from its peak to its bottom. During the 2020 COVID crash, the S&P 500 dropped 34% in just 23 trading days. In 2022, it fell more than 20% again. So market crashes are not some rare fantasy event. They are part of the system. But knowing that in theory and living through it with your own money are two very different things. One of the biggest reasons people panic is loss aversion. This means losing money hurts much more than making money feels good. If someone makes $1,000, they feel happy. But if they lose $1,000, they may feel angry, stressed, embarrassed, or even physically uncomfortable. The loss feels personal. It feels like failure. That is why a falling portfolio feels so painful. Your brain does not calmly say, "This is normal volatility." Your brain says, "Danger, do something now." And that emergency feeling is exactly what causes expensive mistakes. Another reason people panic is that many investors do not truly understand what they own. They buy because someone online said a stock was going to explode. They buy because a friend made money. They buy because everyone is talking about crypto, AI, real estate, or the next once-in-a-lifetime opportunity. But hype is easy when prices are going up. When prices fall, the excitement disappears. The influencer becomes quiet. The friend stops giving advice. The comment section turns negative. And now the investor is left alone with one uncomfortable question: do I actually believe in this investment? If the answer is no, panic becomes almost guaranteed. People who do not understand their investments cannot stay calm during bad times. They have no real foundation. They only had excitement. And excitement is very weak during a crash. Market crashes also reveal who was investing with money they could not emotionally afford to lose. On paper, many people say they are long-term investors. But in reality, they may need that money soon. Maybe it was meant for rent, school fees, family expenses, emergency savings, or debt payments. So when the market falls, it does not feel like a temporary investment loss. It feels like a direct threat to their life. That kind of pressure can make even a smart person sell at the worst possible time. Then comes the power of the crowd. Humans are social creatures. When everyone around us is calm, we feel safe. But when everyone is panicking, we start thinking, maybe they know something I don't. During a crash, news channels become louder. Social media becomes dramatic. Every headline sounds like a disaster movie. Billions wiped out. Investors fear recession. Markets suffer worst week in years. These words are designed to grab attention, but they also feed anxiety. And panic spreads faster than logic. One person sells. Another person sees the selling and gets scared. Then another person sells. Soon, people are no longer asking, "What is this business worth?" They are asking, "How do I escape before it gets worse?" That is how fear becomes a crowd movement. Another major reason people panic is recency bias. This means people believe whatever just happened will keep happening. If the market has been rising for months, they think it will rise forever. If the market falls for a few weeks, they think it will never recover. During crashes, people forget history. They forget that markets have survived wars, recessions, inflation, banking crises, pandemics, political drama, and countless scary headlines. Every crash feels unique while it is happening. Later, it becomes another chapter in market history. The hard part is that many people already know this. They have heard the famous lines: buy when others are fearful. Think long term. Do not panic sell. But advice is easy to repeat when everything is green. Real discipline is tested when everything is red. Market crashes also damage people's sense of control. In normal life, when something goes wrong, we try to fix it. If a car breaks, we repair it. If we are sick, we take medicine. If business is slow, we work harder. But in the market, sometimes the best action is no action. And that feels unnatural. Sitting still while your portfolio is falling is one of the hardest things in investing. The brain wants to move. It wants to sell, switch, chase, hide, or follow someone else's advice just to feel in control again. But in investing, movement is not always intelligence. Sometimes it is just fear wearing a suit. There is also ego. Nobody likes admitting they were wrong. When an investment falls, it can feel like the market is insulting your intelligence. Some people sell in anger. Some hold terrible investments because selling would mean admitting a mistake. Some blame the government, the economy, banks, influencers, or manipulation. But the market does not care about ego. It only reflects fear, greed, expectations, liquidity, and value. The investors who handle crashes better usually have one thing most people do not have: a plan before the panic begins. They know what they own. They know why they own it. They know how long they plan to hold it. They know how much risk they can handle. They have emergency savings. They are not investing money they need next month. And because they made decisions with a calm mind, they do not have to make every decision in the middle of fear. That is a huge advantage. A market crash is not the time to discover your risk tolerance. Sadly, that is exactly when most people discover it. When prices are rising, everyone thinks they can handle risk. But real risk tolerance is not measured when your portfolio is up. It is measured when your portfolio is down 20%, 30%, or more, and you can still think clearly. Many people believe they are aggressive investors until the first real crash teaches them they are not. So why do most people panic during market crashes? Not because they are stupid. Because they are human. Fear, uncertainty, loss, crowd pressure, lack of preparation, and ego all hit at the same time. A market crash is not just a financial event. It is a psychological test. The important lesson is this: crashes are part of the game. They are uncomfortable, loud, and painful, but they are not unusual. Markets move in cycles. Greed pushes prices too high. Fear pulls them too low. And disciplined investors learn not to worship either emotion. People who survive crashes are not always the smartest. They are usually the most prepared. They keep cash for emergencies. They avoid investing money they need soon. They understand what they own. They do not blindly follow the crowd. And most importantly, they know that their biggest enemy is not always the market. Sometimes, it is their own panic. So the next time the market crashes and everyone starts shouting, pause before reacting. Fear may feel protective, but it often leads people into bad decisions. The best investors do not win because they never feel fear. They win because they do not let fear make the final decision. In the end, market crashes transfer confidence from the unprepared to the prepared. And the real question is not whether the market will crash again. It will. The real question is, when it happens, will you be prepared or will you be part of the panic? For more clear explanations on money, psychology, and smarter financial decisions, stay connected with this channel. More practical lessons are coming in the next videos.